Hello everyone and welcome to another Wyckoff class. Now I know you're probably tired of all the Wyckoff jokes, so again, let's get right into the book. Alright, so what we're gonna talk about today is the shaking event. So before the last class we talked about the test, before that we talked about reactions, then before that climax and preliminary stop. But today's class is about shaking. And as Ruben describes here, shaking is the key event that basically all like Wyckoff observers are waiting for. All right? There's no other event like in the entirety of the Wyckoff theory that gives more conviction and strength to the coming trend than the spring. All right? And for the spring to occur, we have two things that must have happened before. All right, so first, we need the stop of the previous trend movement. So if we were trending down, we shouldn't trend down anymore and should be ranging for a while. And not only that, but we need some time to do a full, building of that cause, as we talked about previously in, the previous episodes. All right. So you will probably never see the market, just do a V-shaped recovery or a V-shaped dump, right? You'll basically never see it go straight down and then straight up. Conversely, you'll probably never see it going straight up and then straight down, right? These are structures that you'll probably never see. What you most, commonly see is it going down, then stopping, shaking out everyone, and then finally going up, or the reverse. So it goes up, shakes out everybody, does a final test, and then dumps. All right. This is what you'll most likely see. And you'll probably never see just a V-shaped recovery or a V-shaped dump. All right. And, during those times is both when the large traders are accumulating that stock or, that asset, Bitcoin or whatever, they are accumulating or distributing. Okay. So the spring or the shakeout, it basically means the end of the accumulation or distribution. All right, that is the basic element of the spring. All right. Now, as we know, trading and financial markets in general are zero-sum games, at least in the short term, because for every single buying order, there must also be a selling order on the other side. And so whenever price goes up or goes down, it is because less people are buying or there is less buying volume than selling volume. All right. Now, uh, like because of all that we are dealing with here, and in the other two events like the preliminary stop and the climax, basically all the orders that are down here, all the stop losses that most people set below these levels here, these springs and these shakeouts, they are made just to get that stop loss. If it is an accumulation, it's to get the stop loss or even liquidations of the people who are long. And if it is a distribution, it's to get that stop loss or that liquidation of people who are short. All right. And it is, a pretty common behavior that you'll see in financial markets. All right. So we have that last bit of, push up and people say, oh my god, it's breaking out, and now Bitcoin is going to go to 100k. Or like here, oh my god, Bitcoin is breaking down and now it's going to go to 2k, right? And neither of those things were true, right? Because here we had a distribution and here we had a little bit of an accumulation. All right. All right. So, you'll see that false break, and that's where a lot of people are getting caught, right? If you look back into the liquidation statistics, you'll see that these days here are the days that, a lot of people get liquidated, all right? So let's look at this chart here. We can change it to the daily chart. And as you'll see here, right? Of course, this was a period of relatively low liquidations, but if you look at it, you'll see that basically these times here are where the most people were liquidated during this entire period. All right. And you can see that conversely around the distribution times. All right. So something like this here. A lot of people being liquidated around this last test right here. Right. Right. So how does these springs or shakeouts appear on the graph? Now, Ruben, points some patterns that you might see like the hammer or the bullish engulfing candle or whatever. you know, I don't think that is particularly important. As I mentioned in the past, I think that the most important part of Wyckoff theory is not to learn, if this pattern occurs, then the next structure should be 2 times that. And if you see that candlestick pattern, then it is a UTAD or whatever. The major thing that I want you to learn from Wyckoff theory is how markets move, how to identify the reasons, and how to think logically behind the financial markets, right? Now, you can see, all that Ruben points here. You can pause the video if you want to read that, but I don't think this is particularly important. Now, shaking, and this is the part that I think is really, really important, it serves a purpose in the Wyckoff theory, all right? So the first function that it has is to expel all the people that are trading breakouts, right? So a lot of people would trade a breakout. Like, for example, if we break out of this range here, then you should short because Bitcoin is going to go down. Or if we break out of this range here, then you should long here because it's going to go up. And that's not really smart, right? Usually we shouldn't be trading breakouts because this is what eventually will happen, right? So this is one of the functions of the shakeout, to just expel all of these traders. Secondly, it is to expel the fearful from the market. Together with those, breakout traders, there are a lot of people that are fearful. They think, oh my God, Bitcoin just closed the daily candle below this zone here, and now it's going to go to 5K, and so I should sell all my Bitcoin. Or, oh my God, Bitcoin has just crossed above 62K, and right now it's going to go to the moon, so I should buy as much as I can, right? And this serves the purpose of further feeling the bags of those large traders, right? Finally, it also kicks the smart ones out of the market, because even if you have a good reading of the market, in these times, you might have a bit of an emotional thinking or whatever. Look, we all like to pretend that we are, senseless, emotionless people when we are trading, but we are not. All right. What we are feeling when we see these charts, when we see Bitcoin going up, like even right now, when you see this chart of Bitcoin going up, let's see how much, going up basically 28% in 7 days, do you not get, at least a little bit taken by FOMO, right? We all do. And that's normal. And that's why so many smart traders even get caught. And finally, succeeding with the maneuver. Through all of that, they manage to just accumulate as much as they can for the cheapest price possible and sell as much as they can for the highest price possible, right? This is the main intention of all these shakeouts, right? Now, how should we know that we are facing a potential shakeout? So basically, we can see if it is a shakeout through the secondary test that we mentioned before, right? So basically, if we see a secondary test that shows in the form of an upthrust action, as we talked about last class, this means that there is greater strength to the buyers. And so, like, for example, if we go below that secondary test, then it is more likely than it is, a spring to make us go even higher, right? And the price behavior after the breakout. Now, Ruben will, just mention that a little bit better here. So I'll just go over this quickly. If like the breakout just fails to stay below and re-enters the range again, so that means there is a strong purchase, right? So like right here. So we broke out of this range here. For example, we broke out below these candles here, right? But we didn't manage to stay below it, right? Right in the next day, we had a huge candle and we went back into the range, right? And this was huge. That confirmed that there was a lot of purchasing power, like buying pressure. And so this further confirms like a shakeout. In the case, of course, of an accumulation, it would be the other way around in the case of a distribution, right? Now, as Ruben points here, there are labeling errors. Now, in the sake of faithfulness to the Wyckoff methodology, we should be, just labeling things a little bit more correctly. So a shakeout is only when we see that final event to, just springboard us into the next market movement, right? So this, for example, would not be a shakeout, even though, it shakes out a lot of people. It's not considered a shakeout event in Wyckoff theory. All right. Okay. So let's talk about spring. So the spring is an abbreviation of the word springboard, right? Those things you jump at the pool. I don't know. We don't have much of that here in Brazil. Maybe in the US it's a little bit different. So basically, this is what happens during the accumulations. Now, Ruben also goes a little bit into the history here, but we're not interested in that, right? So there are some types of spring. So first, there is the spring number 1 here, or the terminal shakeout. So this appears really strong in the chart. So we have really, really big selling interest, but it quickly recovers, right? And this, really denotes, even though there was a lot of shaking out, like a lot of selling pressure early, it does denote a lot of buying pressure right after that. And so it might indicate a little bit of a stronger trend in the short term. All right. Now there's the spring number 2 here, which, I'm not making these jokes, right? Because Ruben is making himself, so moderate penetration is observed and we don't go down as much. And we, take a little bit of time to recover from that. This denotes a little bit less strength in the short term. All right. And finally, the spring number 3, where we have just an exhaustion of offer, right? So this doesn't happen because, the sellers, like the buyers, capitulate. It occurs because there's no one else left to sell, right? And this is the spring number 3, where we don't even, spring that much. We just go a tiny bit below it and accumulate down there for a little bit before going up, right? Now, there's also the ordinary shakeout, which would be, akin to the event that we saw here, where we test, back into the top of the range, around the top of that range, and then eventually go up, right? All right. Now, there are some technicalities here, but right now, I think the most important thing for us to learn, besides the shaking and the spring, is the counterpart of that during the distribution, which is the UTAD, or the upthrust after distribution. So as we see here, it is the last point at which the price goes higher and then it finally breaks down, right? Technically, this is just an upthrust, but when we see that happening in phase C at the end of that distribution, then it's called the ultimate, like the upthrust after distribution. And we'll call that ultimate, point of supply or whatever. We'll see about that in the next classes. All right. So we see a minor upthrust. This is a little bit akin to the things before that. We can see minor upthrusts and we can see major upthrusts. They're like terminal, for example, it resembles the terminal shakeout. So it's basically symmetrical. All right. And this is where we end today's class. Now, if you guys only take just a couple things from this video, I will tell you to get this. Every single structure in the Wyckoff theory, it's not random, all right? It is like a thing with a fixed purpose in that distribution or that accumulation, which is just to make the large traders buy as much as they can for the lowest price possible and sell as much as they can for the highest price possible, right? So I think that's about enough for today. If you want to join the Crypto Garden and get access to a bunch of stuff, a future, exclusive Wyckoff course in the future, newsletters, exclusive videos, and whatnot, join us at thecryptogarden.io. And goodbye.